If the economy is supposedly so strong, why does getting a real raise feel completely impossible? You hear it all the time on the news, job numbers are up, companies are doing well. But for so many people, even those with stable jobs, paychecks are just stuck. It's a frustrating paradox. You're not getting laid off, but you're not getting ahead either. So what's really going on? Why does it feel like our income is frozen in place? Let's start by dismantling a common illusion, the illusion of stability. Having a job doesn't automatically mean your income is growing. In fact, for millions, it's just not. We see headlines where major corporations are bragging about their record profits, but how often do you see a headline about them giving company-wide inflation-beating raises? Almost never. That's because a strong economy often benefits the company's bottom line far more than its employees' pockets. From a financial perspective, what really matters isn't just the number on your paycheck. It's your real wage. That's your pay after you account for inflation. If you get a 2% raise, but the cost of everything from groceries to gas goes up by 4%, you've effectively taken a pay cut. You're working just as hard, maybe even harder, but your money doesn't go as far as it did last year. Those charts you see on the news showing economic growth feel meaningless when your own personal financial chart is completely flat. But it gets even more subtle than that. Companies have gotten incredibly clever at implementing what I call silent pay cuts. These aren't direct reductions in your salary. They're much sneakier. Maybe your health insurance premiums went up this year, and the company is covering a smaller percentage of the cost. That's a pay cut. Or perhaps the annual bonus that everyone used to count on has suddenly become discretionary and disappeared. That's a pay cut too. They might have cut back on other perks, like contributions to your retirement fund or education stipends. One of the most common silent pay cuts is piling on more responsibilities without any extra compensation. You absorb the duties of a coworker who left, you're expected to master new software, or your team's goals are increased, but your title and your salary stay exactly the same. You haven't had your pay cut directly, your costs, and your workload did it for you. Your paycheck might look the same, but the value you provide for that money has skyrocketed, and your personal expenses have chipped away at its power. So, why are companies so hesitant to give meaningful raises, even when they're profitable? The short answer is corporate caution. Many executives are looking at the economic forecast, and they're nervous. They see potential for a slowdown, and their first instinct is to protect the company's cash reserves. In their minds, it's far safer to implement a hiring freeze and let attrition shrink the workforce than it is to commit to higher payroll costs across the board. They'd rather hoard cash for a rainy day than invest it in their people. There's another financial pressure point here: interest rates. As borrowing money has become more expensive for corporations, they're looking to cut costs wherever they can. And payroll is almost always the biggest expense on their books. So, when faced with higher debt costs, the budget for raises is often one of the first things to get squeezed. It's a defensive move. They're battening down the hatches, and unfortunately, employee compensation is often seen as a variable they can control. This leads us to something I call the productivity trap. Over the last few decades, worker productivity has soared, thanks to technology, automation, and just plain working harder. The average employee is generating far more value for their company than ever before. But have wages kept pace with that explosion in productivity? Absolutely not. The data is clear. Productivity is up, but real wages have been largely flat. Companies have used technology not just to make work more efficient, but also to delay the need for more hiring and higher pay. One person can now do the work that used to take 3 people, but they're rarely paid 3 times the salary. The gains from that increased efficiency are flowing upwards to profits and shareholders, not downwards to the employees doing the work. The hard truth is, you've become more valuable to your employer, but you're not necessarily being paid more for it. What does all of this actually mean for your personal finances? The practical impact is significant and stressful. When your income is stagnant but costs are rising, your ability to save money is drastically reduced. That emergency fund you're trying to build? It gets harder and harder to add to it. You might find yourself relying more on credit cards to cover gaps, which can quickly spiral into a cycle of debt. And the rise of the side hustle has shifted from a way to earn extra fun money to a means of survival for many. It's no longer about saving up for a vacation. It's about making sure you can cover your rent or afford groceries. The financial pressure of a frozen income forces you to trade your free time for extra cash, just to maintain your standard of living. Your financial buffer shrinks, and your margin for error gets thinner and thinner. So, how are people quietly adjusting to this new reality? This isn't advice, just an observation of what's happening. We're seeing a massive increase in gig stacking, where people are juggling multiple freelance jobs or part-time roles on top of their main job just to make ends meet. Many are also consciously cutting their lifestyle expectations. The dream of homeownership, starting a family, or even just taking a nice vacation gets pushed further and further into the future. We're also seeing a lot of people in career holding patterns. They're not actively looking to leave their stable but stagnant job because the uncertainty of the job market is too risky. So they stay put, feeling stuck but secure. They're making quiet, personal sacrifices, working late into the night on a side project, meticulously budgeting every dollar and delaying major life milestones, all in an effort to adapt to this challenging economic environment. So what comes next? Is this just the new normal forever? My tone here is meant to be grounded, not to spread doom and gloom. This period of wage stagnation won't last forever. Historically, wages tend to lag behind other economic indicators. Meaningful raises will likely return once companies feel a greater sense of stability and the pressure to retain talent outweighs their caution. Many economists believe the period of 2025 to 2026 could see a shift, where flexibility and employee leverage start to increase again. However, one lasting change from this era will likely be the normalization of income diversification. The idea that one job is enough to provide total financial security has been shaken. More and more people will continue to build multiple streams of income, not just as a survival tactic, but as a core financial strategy for the future. The landscape is changing, and while it's tough right now, there is light on the horizon. The fog will eventually lift, but the lessons we're learning now about financial resilience will stick with us. If any of this feels familiar to you, I want you to know you are definitely not alone. This is a widespread experience that millions are going through right now. I'd love to hear from you. Drop a comment below and let me know. Are raises frozen where you work? What have you been noticing? And if this video helped you make sense of what's happening, please give it a like, subscribe for more content like this, and share it with someone who might need to hear it. Thanks for watching.